Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our April monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So before we begin, I want to give a heartfelt thank you for those that have reached out following the news about John Mark. Your prayers and your flowers and your kind words and making donations on his behalf, and even many that attended the service were a comfort and a blessing to myself and my family. So a heartfelt thank you from us. I'll mention some of the words that were mentioned at the service where our oldest said that John Mark would think we were bums for being sad. In that spirit, and with still some sadness, we move forward, living life full the way John Mark did. We also want to honor Sharon Harris, who just celebrated 4 years serving our amazing clients. So congratulations, Sharon. We hope to see many of you at our quarterly investment forum next week. We're expecting a full crowd where we'll be talking about all of these items in more detail. So a lot going on. We will jump right in. So let's address the elephant in the room, and that is an enhanced geopolitical risk over the last 7 or 8 weeks with the war with Iran. Just to kind of revisit where we were, late February, final go order, and at the end of February, Operation Epic Fury officially begins. Now, when we address items like this, we're always thinking about, three things. One is what will happen, next, what could happen, and then what is the market priced in? Well, not surprisingly, initially in the first few weeks of the war, the S&P dropped almost into correction territory by 9%, and WTI, West Texas Intermediate crude, jumped a significant amount as well. So the early stages of the war, again, unsurprising that that's what happened with the markets. Then as we moved into, now time frame, mid to late April, the S&P had a closing high of just over 7,000, and WTI is now trading in the 93, 94 range. So markets are now pricing in less of a geopolitical risk. Now, as we examine this further, we believe that the geopolitical risk is lower, but that's based on a lot of big ifs, as is pictured here. One is that the ceasefire holds, that there's some form of negotiated deal, that the strait is mostly open, and that we're closer to the end than the beginning. So we think if these things hold, or if at least most of them hold, the geopolitical risk is lower. The markets are currently reflecting that. Of course, any of these ifs that turn into no, you could have geopolitical risk back on, which is all the markets have really been thinking about the last 7 or 8 weeks. If we can get beyond this geopolitical risk, the next thing that the markets are really focusing in is earnings. Earnings expectations are 14% year over year compared to a 9.5% average. So this would very, very much be a tailwind in the economy. In fact, what's interesting in the first quarter, even though earnings did well, you actually got a better price earnings ratio on the S&P 500 because the market declined. So you went from a 22 times forward earnings to 19. In fact, interestingly enough, this is a look on this left side of earnings growth compared to what the markets did. And so you had a very unusual 8.1% earnings growth while having a 4.4% return. So stocks, at least in the S&P 500, got priced better as a result of the market decline in Q1. The earnings are coming from primarily tech and materials, so that's what's kind of leading earnings expectations going forward. And this goes back to 2025. And again, this is because of earnings. that you actually got, even though stocks were up in 2025, the price of those stocks got lower because of earnings. So again, an unusual period of time where even though the prices have gone up, notwithstanding the first quarter of this year, you're actually getting a better price because of how good earnings have been. So a lot of uncertainty as it relates to not only the Federal Reserve chair, but what's the next move on interest rates. Jerome Powell, as you may know, is set to end his term as chair mid next month. The nominee who was in Washington yesterday is Kevin Warsh. Keep in mind, Powell still stays on as a member of the Board of Governors until January 31, 2028, if he chooses to do so. So the Fed chair is uncertain. That's going through a process now and something we're keeping an eye on because the Fed will have a decision to make next week where we're expected to pause again. So again, we went through these last three declines, rate cuts. January 28th started a pausing cycle, and then we expect that to continue April 29th. In fact, markets aren't predicting a rate cut until mid-year this year. And as it relates to how long we're in pause mode, this just shows when we've been in pause mode, how long that's been, from 3.5 to 9 months, going back to 1990. So we're kind of in that January, we started the pause period of time. If we end that in June or mid-year with a rate decrease, we're in about that period of time. So election, we're in the kind of midterm year. And what's interesting about that, if we look at this kind of orange, you look at pretty muted returns until the end. And part of what you get with Q4 is you get some uncertainty as to the results of the midterm elections. And so that tends to be the kind of recovery quarter in a mid-year election cycle going back 100 years. We're also in kind of the year two of the presidency, and the midterms tends to be lower in return and higher on drawdown. So just typically year two overall, lower return, higher volatility. So the One Big Beautiful Bill Act is supportive of growth, at least in 2026. A lot of the kind of fiscal stimulus is kind of front loaded into 2026. So that's estimated to add between 50 and 80 basis points of real GDP growth in Q1. So that's something to keep an eye on. So where are we in the current bull market cycle? We're in the one that started in October of 22. So that's about 3.5 years, and we're up 94% over that period of time compared to the average bull market's 192 and up 5.6. So compared to historical averages, we're kind of halfway in both date and momentum. So this is another interesting slide, kind of unpacking the environment that we're in now with kind of the AI boom compared to the tech bubble. What this shows is the earnings growth up 79%, but stock returns were up almost 6x greater than earnings returns. And what you see today is that's inversed, meaning the earnings growth are actually higher than the stock return. So what this tells us is that compared to the dot-com or tech bubble in 2000, that the returns are substantiated by earnings. In fact, the returns aren't even as great as what the earnings growth has been. So overall jobs pretty good in March after a bad February, up almost 180,000. Claims that came out this morning, 214,000, which kind of just repeats that we're in a low hire, low fire job environment. CPI most recently up 3.3%, not surprising. Gas, a big component of that, as oil prices have gone up following the Iran war. And Q4 GDP down or up 0.5, but that's a significant slowdown compared to prior quarters. So something to keep an eye on. Another thing to keep an eye on is just this record amount of cash is sitting on the sidelines, almost 8 trillion. Whenever we've been through money market peaks or cash peaks before, What that typically shows is that that's supportive on a 3-year basis of stocks going back to these other times where money market rates peaked. And this is just a further zoom out. We talk about this a lot. We look back at 100 years in the market. We've got 74 of those 100 are up, 26 down. All of these down are painful years. But the momentum is on the upside, as is the average return, almost double the average down market. So this is just a zooming out kind of perspective. We sent out trade notes recently that talks about the changes that we're making. We attempt when we rebalance not to over or underreact what's going on in the markets. The goal of rebalancing, according to your preference and profile, is to have the highest probability of success over the widest range of outcomes. And so you'll see those notes detailed in recent trade notes that we sent out just a couple days ago. So none of this is a replacement of contacting us directly to discuss how all of these things apply to you. So please reach out. We're here to serve you. With that in mind, hoping that we'll see many of you next week at our quarterly investment forum. We will close. Again, I want to thank each and every one of you that has reached out to us in many different ways, and prayers and good thoughts and cards and flowers, and supporting the adoption agency and all of that has been such a comfort to us during these last few weeks. So with our heartfelt appreciation, thank you. And we look forward to seeing many of you next week at the forum. Until we see you again, be well and take care.